Eric, why do I want to be in emerging market bonds heading into 2026?
Because these are the countries that have the opposite situation that most bond investors are working with, which is their government bond markets have high government debt levels and central banks that can't only focus on inflation. EM is filled with countries that have very low levels of government debt and central banks that act accordingly, namely focus solely on inflation. So they're dollar bonds, they're good credits, more dollars in assets than liabilities, but this is infecting their local currency markets especially. And Asia is the first for 6 years now. It's been a defensive play. So good fiscal policy is the core argument.
And VanEck has the emerging markets bond ETF. The ticker is EMBX. Can you tell me how the bonds in this particular ETF are distributed in terms of Asia, Latin America, Eastern Europe? Where are all the countries who are issuing bonds in your portfolio? What's the breakdown?
Yeah, great question. The most important thing about the fund is it represents our the ideal way, in many opinions, for institutions to access EM bonds because it invests in all the alpha in EM bonds, not only dollar-denominated bonds or their credit spread, but also local currency bonds. Most institutions get the case for EM bonds, but the implementation is very specific. So that's the most important point. Consistent with that framing, we have about 40% of the fund in local currency EM bonds right now. We've been as high as 60%, and we are neutral almost everywhere. We're directionally bullish. Our significant overweights are Chile, benefiting from a recent election. We like South Africa, but it rallied a lot. We liked Brazil as well, and it rallied a lot. And we see opportunities in smaller situations in Latin America, Venezuela, Argentina, and others.
Can you talk about how you are navigating the decline of the dollar when managing your portfolio? Because the dollar has really not done well over the last year or so. It's almost acting like an emerging currency.
Fair. You know, our framing has been that DM is the new EM, and EM is the new DM. I think first point is this is analyzable and has been going on for a long period of time. And it's driven by fiscal policy, accelerated by the global financial crisis and sanctions, but it is long in train and analyzable. And if you look at it that way, I think the framing becomes the dollar is not going to lose its status, but can it share its status with other deserving currencies? Absolutely. What are the obvious currencies? Well, gold, we know the story there. We also know that the central banks didn't send a press release. What others? My currencies. CNY. When you saw all those headlines in the last 5 years about UAE, India, Brazil, China agreeing to trade in each other's currencies, do you think a financial counterparty is going to want a pile of cash? They're going to open a bond line and they're not going to send a press release.
It seems as though the politics in Latin America have actually shifted a little bit rightward. I mean, you certainly see that in Argentina. Can you talk about how that's affecting your portfolio? Because politics and economics go together in an emerging market bond portfolio.
Unfortunately for DM, politics and economics also go together, which is a big part of our point. But no, you bring up a key fact. The current U.S. administration, and I think this continues across the partisan line, has a big strategic focus on Latin America for lots of reasons we don't need to get into here, and it has a direct impact. If there is a 10-year theme out of it, we'd trade every day, so I'm not the biggest fan of those kinds of things. It would be convergence. Convergence between their inflation and interest rates and ours. Now, that's a big theme. The specific things we've seen have been more than just Argentina and the obvious swap line, have been more than just Venezuela, which are small parts of the benchmark at the end of the day, where we see in the daily news. It is places like Chile, a big move to market friendly, and very specific evidence of supportive U.S. attitudes. One of my favorite examples is Bolivia just had an election. Both presidential candidates that were market friendly reached out to the market. It was very clear they explained the lengths to which the U.S. administration had gone to smooth their transition once either one of them got elected. They're doing tough things on the budget, provide support during that window, for example.
And then finally, one more time, can you give me the case for emerging market bonds in 2026 and why we're going to get better yields, better prices, better everything as opposed to domestic bonds?
Yeah, the case for emerging market bonds is fairly straightforward. These countries' governments have low levels of debt. That allows them to be good credits in dollars and their spreads, but it also over time has made their local currency markets very attractive. So their central banks and their markets pay high real interest rates. Most fixed income is exposed to developed markets, which have high levels of government debt and central banks that are not defending them exclusively by focusing on inflation. So it's very thematic, and you're getting about double the yield, for example, in EM sovereigns than you would in DM sovereigns.
All right, well, thanks for coming on and talking about it.
Thank you, Greg.